I owe the bank almost $3 million. And in this video, I'm going to explain to you how I've structured that across 4 different properties. First off, look, there you go, almost $3 million worth of lending. And this is how I've structured it. Just a reminder, this is not financial advice. This is just how I've done it, and everybody's going to be different for their circumstances. So I've got home separate from the investment properties. It's worth approximately 1.4 million. There's a 100K offset, which is fully offset, and then 2 fixed portions on the 1 year and 2 year rates when I set them up. That's not how much is left. That is just when I set them up on those terms. Then you've got 3 investment properties. Number 1 is worth about this and rents for that. This was the first one I bought. Number 2 is probably worth around that and rents for that. And then number 3 is worth $850 and rents for $685. This is the most recent one I bought about 12 months ago. And these are structured this way. So the first one has got fixed portions between 1 year, 18 months, and 2 years. This extra fixed portion was an equity release to buy the next properties. This one here is on floating because it's actually being sold. Settlement is this month, and I'll replace it with a higher performing one because that cost is not covered by the rent. So I need to find something that is. And then this one here is fixed for 1 year and for 2 year across this mortgage amount. Now this thing here is my offset account for rental funds. So basically there's about $54,000 in there. So it's 100% offset, and I use that money if there's any maintenance things for these. Now you could argue that that's not a good idea, because why would you save interest on this property when this is all tax deductible interest and this is not? But this is just how I've set it up. And if you want to know the pros and cons of that, that is a accountant question. Then down here, I've kind of put considerations. This is not how I've set it up, but like if you spoke to a lawyer or accountant, you might think to put your home in a trust. And if you spoke to a lawyer or accountant, you might also think about company structure. So you own these in one company, or you could have separate companies per property. The pros and cons of that, a bit complex, and you need to talk about that with an accountant. Obviously you can just have it in your personal names, or you can separate it further by having separate banks for these. I think that's a bit overkill at the moment. If I was to buy a 4th property, then maybe you'd have 2 properties at one bank, 2 properties at another bank, and then your home at another bank, so a 3rd bank. And the reason for that is just to protect it, because if you've got everything at one bank and you sell this property and want the sale proceeds, the bank could say, hold on, you've got all this other debt with us and we want the sale proceeds to pay this off because we don't think you can afford it. So that's very likely to happen later in life, and you want to kind of set it up when you're younger to make sure that doesn't happen, because that could obviously ruin your retirement plans. Yeah, so that's pretty much how I've got it set up. Again, this is not financial advice. Talk to me or someone else in a financial advice position if you're in a similar situation to do this. The most common thing that I see is people just have one home, one investment property at the same bank, and they don't realize that they should be separating it, or they have like 2 investment properties and want to buy a 3rd. So hopefully that helps.